Let's now go across to Mr. Niranjan Hiranandani, who is joining us on the broadcast. Good morning, Mr. Hiranandani. Thank you very much for joining us here on Mirror Now this evening. Good to have you on the show today. Your first reaction to the policy decision, repo rate has been increased by 50 basis points. What does it mean for the real estate sector?
I think, first of all, let's be clear. This was an expected hike, and so the markets were ready positioned for the purposes of this increase. So I don't think there's any surprise as far as the real estate sector is concerned, and quite ready for it. However, over a period of time, obviously, loans will get, home loans will get more expensive for the immediate future. But this will probably last over a period of time of maybe 6 months to a year, because ultimately the war will get over, inflation will be contained, and after that, the things will come back. And most of the loans are 10 years, 15 years, 20-year loans, which people are taking. And obviously, with a floating rate of loans, the EMI will come down again. But yes, there will be a temporary setback in terms of people who want to initiate the loans, because the present new EMI is going to be high. So there will be some reluctance for people to take the loans in the immediate future. But in the long run, this is not going to make any long-term effect. You don't actually buy a house or not buy a house because interest rates have gone up by 0.5%. That doesn't happen. Yes, there will be people who may want to say that, no, we don't want to spend as much for a home loan as you would for a home price because interest rates have gone up. That is a temporary setback which will definitely take place as far as the people who will initiate new home loans. But otherwise, in other segments where the loans are not being taken, I don't think there's much change going to take place. In fact, people will buy more because they know that inflation is going to increase the cost of the house in the future. So to buy now rather than buy in the future and with the benefit of other things which are there. So the interest rates going up to around 7% is 7.2% is what is expected. And I don't think it will make too much difference in the long run, but short run, yes, it will have an effect.
Did you see any sort of an impact first time when we saw the Reserve Bank of India increasing the repo rate by 40 basis points in the overall real estate market? Because, I asked you that question, Mr. Hiranandani, specifically because already Mehngai is a big concern. It is eating into our monthly savings, and we do not know for how long this uncertainty is going to continue. So amidst all of this, don't you think this will deter people from even considering buying a home right now, because the future looks a little uncertain? Every time we hear the RBI governor speak about what's happening in the domestic market and our economy, he speaks about the external factors which nobody can control. And yesterday only the World Bank has also slashed global growth forecast. India's growth forecast has been slashed too.
There are two views on that. One is the view which you have stated, and I want to give you the other view. Look at the monetary, the monetary impact is done by the Reserve Bank of India. But you see the fiscal impact which the government of India has done. It brought down the rates of petroleum products. It brought down the rates of this thing. They put ban on the sale of steel and other products in terms of putting in duties which are for the purposes of exports. So all in all, if you combine the monetary along with the fiscal impact, I think inflation can be brought under control. According to me, only monetary control by increasing interest rates, you're not going to bring down inflation at all. Because as you said correctly, it is depending on external factors and you can't control them. But intervention by Government of India on the fiscal side definitely is going to make a difference. And I hope that government will also further steps to do it. After all, GST collection has grown exponentially. And if some part of it is used for the purposes of reducing GST the rates of for petroleum products further, the inflation control, or in terms of further duties in terms of exports, it will on the prices of steel, cement, other materials which are taking place in the marketplace, and also fuel into the economy. So a combination of both monetary and fiscal intervention will bring down inflation faster, and I believe we will be able to control of it. But I'm happy that both of them are working in tandem. The government of India is also working in tandem with the RBI intervention. So I think a combination of this will work. But monetary intervention alone will not solve the problem.
Absolutely. And now with states also, beginning to lower VAT, with the RBI governor also asking states to, in a way consider lowering VAT on fuel to soften inflation, can also be something that we'll look forward to. Dr. Niranjan Hiranandani, thank you very much for joining us here on Mirror Now. Always a pleasure to have your views on the show. Dr. Niranjan Hiranandani, National Vice Chairman, NADECO, co-founder and MD, Hiranandani Group, speaking to Mirror Now on the RBI policy this morning.